When companies do business in different countries, they often face the challenge of dealing with multiple currencies. They often get paid in different currencies, which can complicate financial transactions and accounting. Imagine a company in the United States selling toys to a store in Japan. The logistics of such a transaction involve more than just shipping the products. The store in Japan will likely pay for the toys in Japanese yen, not US dollars. This means the US company must convert the yen into dollars. This difference in currencies can be tricky because exchange rates fluctuate constantly. The value of currencies can change every day, sometimes even multiple times a day, influenced by various economic factors. If the Japanese yen becomes less valuable compared to the US dollar, the US company might receive fewer US dollars when they exchange their payment. This can affect their profit margins. This is where currency trading comes in. Companies engage in forex trading to manage these risks. Businesses can use different tools to manage the risk of changing currency values. These tools help them stabilize their financial outcomes. One of these tools is called a Non-Deliverable Forward, or NDF. NDFs allow companies to lock in exchange rates for future transactions, providing a hedge against currency fluctuations. An NDF is like an agreement between two parties to exchange a certain amount of money in one currency for another currency at a specific price in the future. However, unlike a regular forward contract, the actual exchange of currencies doesn't happen. Instead, they settle the difference in cash. Imagine it like making a bet on which currency will be stronger in the future. If you're right, you get paid the difference. If you're wrong, you pay the difference. Let's say a company agrees to buy 1 million Indian rupees, INR, from a bank 1 month from now. This agreement is made to hedge against potential currency fluctuations that could impact the company's financial position. The agreed exchange rate is 80 INR per US dollar. This means the company expects to pay a certain amount in USD to receive the INR. This agreement is known as a Non-Deliverable Forward, or NDF. It is a financial derivative used to manage currency risk. 1 month later, the actual exchange rate is 82 INR per US dollar. This indicates that the value of the INR has decreased relative to the USD. This means the INR has weakened against the USD. As a result, the company would have to pay more USD to buy the same amount of INR if they were to purchase it at the current market rate. The company would have been better off buying INR at the current market rate. However, because they entered into an NDF, they are protected from this unfavorable movement in the exchange rate. Since this is an NDF, there's no physical exchange of INR and USD. Instead, the settlement is made in USD based on the difference between the agreed rate and the actual rate. Instead, the bank pays the company the difference in value. This payment compensates the company for the adverse movement in the exchange rate. The difference is calculated based on the agreed-upon exchange rate and the actual exchange rate on the settlement date. This ensures that the company is financially protected against currency volatility. An example with INR and USD. Imagine a US company expects to receive 100,000 Indian rupees, or INR, in 3 months from a customer in India. This scenario is quite common in international trade, where businesses deal with multiple currencies and face the risk of currency fluctuations. They are worried that the INR might weaken against the US dollar, or USD, in the next 3 months. Currency exchange rates can be highly volatile, influenced by various factors such as economic data, political events, and market sentiment. To protect themselves, they enter into an NDF with a bank to sell 100,000 INR at a predetermined rate, let's say 80 INR per USD. An NDF, or Non-Deliverable Forward, is a financial contract that allows companies to hedge against currency risk without the need for physical delivery of the currency. After 3 months, if the INR weakens to 82 INR per USD, the company will receive the difference from the bank in USD. This means the bank will compensate the company for the loss incurred due to the unfavorable exchange rate movement. However, if the INR strengthens against the USD, the company will have to pay the difference to the bank. This ensures that the company is protected from significant losses, but also means they might not benefit from favorable currency movements. Why are NDFs used? NDFs are particularly useful for businesses operating in countries with restrictions on currency trading. These restrictions make it difficult to directly buy or sell the currency in the open market. NDFs provide a way to manage currency risk without actually exchanging the restricted currency. They are like a safety net, protecting businesses from losing money due to fluctuating exchange rates.